we sort of have to work around the uncertainty that we're living in now and come up with the best plan moving forward. I think the other piece that is important, of course, is that we did get a bit of a 1 quarter reprieve for many of those tariffs, so that helped. And two, the actual economic impact, particularly for market players, and I invest in emerging markets, so I'm speaking particularly for emerging market companies, may be more limited than we think. Right? There was interesting news today that something like a third of U.S. imports are still subject to exemptions under the new tariff rules. So as we sort of wade through the uncertainty and we wade through the vast number of exemptions, and then maybe can make assumptions that we'll see some deals that will be hopefully better for particularly the emerging market economies that I operate in. Hopefully it gives companies enough room to begin planning, but I think you have to plan within an environment of pretty significant uncertainty.
Derrick, when we talk about your space, EM, emerging markets, right? Although, I mean, right now, sure, they're looking much better value. Earnings are growing faster than they are in the U.S. I get that. But, historically, when we think about EM, we think about a certain risk premium being assigned to them to do with, not full 100% transparency and a certain amount of opacity that I think investors are just going to have to live with, right? That comes down to data as well. We like to joke, and we've been doing this for, more than a decade, right? About how China's numbers are kind of hard to believe sometimes. Well, turns out that, over the last 48 hours or so, we're given to understand now from the president himself that the BLS has been, pulling the wool over our eyes. I mean, the revisions to the 2 prior months on the back of the payrolls report, he says are rigged. We've been talking to a number of guests about that this morning, and they're saying, look, they wouldn't go so far as to say that the BLS has rigged the numbers or is lying or doing anything of the sort. It's probably more to do with a data collection and maybe a modeling issue. But be that as it may, U.S. data, if you cannot trust the integrity, the almost sanctity of U.S. data, that just undermines this whole idea of U.S. exceptionalism. I mean, it's just, one more straw which looks like it's going to break on this camel's back, in addition to the continued pressure the president's putting on Chair Powell.
Well, you're right, and I've been ranting about this at dinner all weekend. That we've been giving the Chinese a hard time, and every time I talk to investors, particularly in the U.S., about, I get pushback saying we can't believe the Chinese data, and I recognize there are real flaws in that data. But I think now we're seeing similar problems in the U.S., and I think it speaks to a broader trend that we're seeing, and the relative riskiness, in my view, of U.S. assets, which still are quite solid, versus emerging market assets is narrowing, right? So I would say investing in U.S. assets has become marginally more risky, where over the last decade, I think investing in emerging market assets has become marginally less risky. If we look at for instance, the current account balances of most emerging market economies have improved dramatically over the last few years. We've seen debt upgrades both at the corporate and sovereign level within the emerging market space over the last few years. And emerging market debt, which is not a space I play in, has seen yields converge toward treasuries in a significant way. So I think you're exactly right. What it says to me is, if I'm looking to allocate capital around the world, emerging markets still risky, but certainly look relatively less risky versus the U.S. than it did maybe 6 or 7 years ago. And certainly maybe.
Well, let me pin you down here on strategy a little bit then. Sorry, Derrick. Let me pin you down on strategy then a little bit, because you were saying earlier that, the latest round of tariffs on countries around the world, including emerging markets, has created more uncertainty, not less, but you have to invest around it and come up with the best plan. What is the best plan to come up with?
Sure. Look, I think that there are a lot of other drivers in emerging markets right now that make it a very interesting place to invest. So the good news is I don't think I need to predict whether tariffs are going to be 20% or 19% to invest successfully. I think, for instance, if we look at China, I would expect to see a continued, if rather slow motion move towards stimulating consumption. And I think there's great opportunities there. Of course, the artificial intelligence opportunity in China is excellent. And outside of China, the Indian market has been weaker and is going through a soft spot. And I think there's opportunities to begin to pick up really great assets with a great long-term story after that market softened a bit. And then even outside of Asia, what I would be looking for is a broader trend in Asia and outside of Asia for rates to come down in emerging markets. You know, the weaker dollar in the first half of the year and falling inflation globally has given emerging market central banks this incredible opportunity to begin cutting rates without damaging their currencies as much. And that can be very stimulative to emerging market stock markets. So I think I can look beyond the uncertainty of tariffs and really look for opportunities at the country and company level.
And that's a really interesting point that you're making about the weakness of the US dollar, which admittedly did have actually a pretty good month in July. But, you were saying that if emerging markets in recent years have become marginally less risky to invest in, but investing in the United States and US assets has become marginally more risky, would you think that the US dollar has further structural downward pressure to come?
Look, I think that we have been in a very long, more than a decade long bull market for the US dollar. It was already getting tired. And now we're looking at an environment where the US is slowing, not only versus emerging markets, but in its own right. We're likely to see rate cuts out of the Fed, which is not supportive of the dollar. And I think most importantly, we have an administration that I think has indicated that they would prefer a weaker dollar. So I look at all those things and say I have an expensive dollar after a long bull market run. I have growth slowing, rates cutting, and a president that would like to see the dollar weaker. And it's probably the direction of travel. Again, as you mentioned, a very strong month in July, but that was probably more a reaction to some of the short-term data.
Boy, talking about lower rates, Derrick, and there's a certain irony here, right? Because, you could, and some people have been making an argument that, the U.S. is kind of starting to trade like an emerging market right now, right? But the only downside is, unlike a lot of emerging markets, right, where you can expect to be paid for the risk, right? Whether it's, in their bonds or in their equities. With the U.S., I just crunched some numbers here. The average yield on the S&P right now is 1.25%. And the 10 post that jobs report, that huge miss, we're at 420. You could make an argument that, if the U.S. were an emerging market, you're certainly not getting paid for the risk, for the policy risk, the political risk, or anything like that.
I agree with you. And I look around at some of the countries where we invest, say Indonesia, which has struggled over the last year or so. Its stock market has struggled. But we think that there are great growth opportunities there, and we're being paid significantly higher dividend yields to invest there now, 5, 6, 7% dividend yields to wait for the economy to turn around. And I look at that and think, is it really that much riskier than investing in, as you said, the U.S. right now? And I think the answer is, on a relative basis, probably not. Certainly, if I were allocating capital around the world, I would want to marginally put more assets into the emerging markets just as a diversifier.